Okay, guys, good morning. So, I welcome every one of you on behalf of Funda Zone for today's discussion for November 2020 SFM question paper. The November 2020 question paper has been subject matter of lot of trolls and memes. Many people in Facebook, WhatsApp, Telegram, they are all saying that it's one of the toughest question paper. FR seems to be very easy, it seems. FR was easy, it seems. And then they said SFM was very difficult amidst COVID, WD. There are a lot of review comments. So I thought, let me take it up for discussion. So, guys, the first thing I would like to share is question paper is a pretty decent question paper. It's not that easy. It's not that difficult. It's a moderate question paper. There are some straight questions. There are some questions where you will have to think. To everyone, Bharat, see the point here.
Yes, sir. Oh.
Question paper tough abdina when people say in SFM is that when they have a question which they have not solved it.
Okay. Okay.
As long as you get a new question in the question paper, people immediately say that it's a tough question. There is actually a difference between a new question and a tough question.
Okay.
So many questions are new, but they are not tough. Just you need to think in the exam hall so that you can write.
Okay, sir.
Right? Okay, let's get into the question. Question 1. Okay, I'll tell you what is the idea. I'll read the question and then I'll slide through the answers and quickly we'll jump question after question. We'll not be spending full time in detailing it. I'll share with you the answers also. It is also uploaded in our website, so you can check it from there.
Sure, sir. Sure.
I'm getting some feedback. Someone has to mute their mic. Thank you. So question 1. Nila, can you see the question?
Yes, sir.
Yeah. So as the question reads, ZX Limited has made purchase worth $80,000 on 1st May, for which it has to make a payment on 1st November. Present exchange rate is INR per USD 75. Company can purchase forward dollars at INR per USD 74. The company will have to make an upfront premium at 1% for forward amount purchased. Cost of funds to ZX Limited is 10% per annum. Company can hedge its position with the following expected rate of USD in the forex market on 1st May. On 1st May, the expected rate 77, 71, 79, 74 with these probabilities are there. You are required to advise the company for a suitable cover of risk. I'll quickly skim through this. Now you have what position you have? You have purchased raw material, correct? So they have to pay. There is a liability position. You have a forex liability, $80,000 you have to pay. You purchased it on 1st May and you have to pay on 1st November. On 1st November, what is the forward rate which is applicable? Spot rate is 75. The forward rate is 74. Correct? So if you enter into forward, so can someone tell me you need to do a forward buy dollar or forward sell dollar?
Forward buy dollar.
Forward buy dollar, sir.
Forward buy dollar, right? So at the rate of 74. So on that day, what will happen? 80,000 into 74 rupees is what you will have to pay. That's your cash outflow. But one thing to be considered is for that you will have to pay an upfront premium of 1%. So $80,000 into 74 in order, 1% has to be calculated. That has to be paid today itself. Now that will carry a 10% rate of interest because you are going to pay out of your working capital. So premium interest, and then 80,000 into 74 is going to be your net cash outflow if you are doing a forward contract. If you don't do forward, what will happen? These will be the exchange rate, correct? 71, 77, 79, 74 with these probabilities. So you can do a weighted average and then find out what will be that day spot. That's what it means. 1st May, you are expecting that 1st November, these are all the rates which are possible. So take an average and then figure out what could be the average rate. That probably would be the rate prevailing on 1st November. That is what will be your cash flow. If you keep it free, if you keep it naked without taking any forward contract, without taking any hedging position, whichever results in lower cash flow, you may have to opt for that. Are we clear on this model?
Yes, sir.
Yes, sir.
Let's move on to the answers now. Just listen. I'll skim through the answer and then I'll share you this because within this limited time, we need to cover all these questions. USD to be purchased in forward market is $80,000. Forward rate on the 74. So total cash flow is 59 lakhs 20,000. On that premium payable now is 1%, 59,200. The interest is 6 months forward. May to November, 6 months forward. So 59,200 is the premium that you pay today. For that interest is payable 59,200 into 10% into 6 by 12. So 2960. So your total cash flow is these three things put together. Correct? This is what will happen. And if you don't take a forward, what will happen? 80,000 into that day spot. That day spot is nothing but 77 into 0.15, 71 into 0.25, 79 into 0.2, 74 into 0.4, the whole thing, 74.4. So whichever results in lower cash flow, this is what will be preferred. Are we clear on this? Can I move on to the next question?
Yes, sir.
It's a straight question, straight simple question. I don't
Yes, sir.
call this as a difficult question at all. How many marks is this? 8 marks. First
8
question.
mark question.
லட்டு மாதிரி இருக்கு. Next, first question தான் அப்படி இருக்கும். Second questions and all they will start screwing. Second question, it's also an easy question. A two-year tree for a share of stock in ABC Limited is as follows. Share price 100, 108, 95. There are two prices probable, 108, 95. Okay. And this 108 after 1 year, second year it will become either 116.64, 102.60. This 95 will become 102.6, 90.25. I want you to check this question B. We have solved a similar problem in binomial model. I'll read through this question and then I'll tell you the reference also. Consider a 2-year American call option on the stock of ABC Limited with a strike price of 98. Strike price on the 98. It's a call option. Seriya? With a strike price of 98. The current price of the stock is 100. This is the spot price. Risk-free return is 5% per annum. What is that?
RF.
RF. With a continuous compounding and E power 0.05 is 1.05127. Sorry. Assume a 2 period of 1 year each. 2 periods of 1 year each. 1 year, 1 year. Using binomial model, calculate the probability of price moving up and price moving down. Expected payoff at each nodes in N1, N2, N3. Round it off to 2 decimal points. First, probability. Find out the probability. If you look at this carefully, you have a spot price 100. Correct? At the end of the first year, either it will become 108 or it will become 95. Your share price, I'm saying. I'm not talking about option price, your share price. Now let's get into this binomial model. Your spot price is 100, correct? So either it will become 95 1 year from now, or it will become 108 1 year from now, right? If you remember the binomial model, the probability of upper, probability of lower, and if you remember, there is a formula which is available, correct? So 100 rupee will become 95, which means 0.95 will be the growth. 100 rupee will become 108, which means 1.08 is the growth, correct? So if 100 rupee, if you are investing in a share, it will either become 0.95 or 1.08. 100 rupee, if you are investing in an RF, that 1 rupee will become 1.05127. So what is the probability of upper cash flow? Probability of upper cash flow 108 is F minus D divided by U minus D. Correct? If you can brush up that topic, you will be able to get a grip here. Okay. So this is F minus D divided by U minus D. This is the total probability. So you get 77.9%. Probability of lower cash flow 95 remaining 1 minus 77.90. Or you can say U minus F by U minus D. Correct? You get 22.10. So what is the answer to this question? The probability of upper cash flow is 77 point something, lower cash flow is 22 point something, so on and so forth. 77, 22, 77, 22. Correct? So this answers the first part of the question. This is the probability of price moving up and price moving down. Expected payoff at each node. What is the payoff at each node? N1, N2, N3. Let's talk about இது N1, இது N2, இது N3. N2, what will be the payoff? It's a call option, correct? Call option is a right to buy. What is the exercise price here?
98.
98 is the exercise price.
98.
So you are standing here, if you are standing at 108, in future the price can be 116 or it can be 102, correct? And you have an exercise price of 98, 98, 98. So you have a right to buy for 98, where the market price expected is either 116 or 102. You will exercise the call, correct? In both the cases, you will exercise the call. If it is 116.64, what is the profit you will make? 116.64 minus 98. If it is 102.6, what is the profit? 102.6 minus 98, correct? So that's the profit that you will make. And you know the probability of this and probability of this, 77.22 something. So multiply it with the probability, you get the average benefit that you will get out of an option. Discounted to the present value, you get the value at 90 N2. The payoff na enna artham, what is the value of that option artham? Seriya? That's the second part. So your strike price is 116 or 102. That is these two numbers, 116, 102. Your excise price is 98 in either case. You will definitely excise. The gain you will be making is this. Your probability you already know. Weighted average, you get what is the average value of an option? 15.54. Clear?
Yes, sir.
This is the
Yes, sir.
probability as on that date, second year end. So the value as on first year end, that divided by 1.05 something, right? That 1 by e power RT. You discount it to the present value.
Yes.
Doing your right. Similarly, calculate the payoff at N3 and so on. N3 is this number, right? 95. If you are standing here, in future either it will be 102 or it will be 90.25. Your strike price is 98, correct? So if it is 102.20, you will exercise the call. If it is 90.25, you will lapse the call, correct? So let's find the value. 102.60, 90. So it's either 98, 98. Exercise lapse. Exercise panna, this is the benefit that I will be getting. Probability, weighted average probability, discounted. So you get the value of an option today. And if you are at N1, N2 Leo, N3 Leo, what is the value of an option? N2 la the value of an option is 14 point something. N3 la value of an option is 3.41. These are all the probabilities, weighted average, what is the benefit, and discounted to the present value. So this question is a very normal question. Binomial, this is the only question that you can think about. Either you will be given in classroom questions, you have one similar question which we have solved, where the parameters RF will not be there. I want you to check your notes to find that. See, this is
Sir,
the spot.
I think, sir, sorry to interrupt. I think it's that Vimal Organic Foods, new listed company in our question.
Exactly.
Yeah.
VOF, you are right. Vimal Organic Foods.
Yes, sir. Yes, sir.
Mono parameter irukum. There will be a spot price. There will be a future price. There will be an e power RT, that is the RF. There's going to be a strike price. Any one will be missing. You have to find that out.
So in the question on the RF on the first RF on the first category they would have asked to find out.
The question that we solved in the classroom, the probability will be given. RF will not be there.
Yes, correct.
This question, RF is given, probability will not be there.
Okay. Understood, sir.
See, binomial model, if you know that model, that's it. Get to know about that model. Any question that comes, you can keep solving it.
Okay, sir.
Right. Next, third question. On Tuesday morning, I'm moving on to the next question. On first, giving you a backdrop, there are totally 6 questions in this question paper. 6 questions. 6 questions like A, B, C. So 6 into 3, 18 questions are there in total. With choice, I am saying. In every subpart, there is one question which is theory. So if I remove that out, every question has got 2 parts. So 6 into 2, 12 questions are there. Only in this question, you don't have any theory. A, B, C, all the 3 are problems. On Tuesday morning, before opening of capital market, an investor, while going through his bank statement, has observed that an amount of 7 lakhs is lying in his bank account. So he has got 7 lakhs balance. This amount is available for use from Tuesday till Friday. Tuesday, Wednesday, Thursday, Friday. 4 days the amount is available. The bank requires a minimum balance of 1,000 all the time. The investor desires to make a maximum possible investment where value at risk should not exceed the balance lying in his bank account. The standard deviation of market price of the security is 1.5% per day. The required confidence level is 99%. So how do you go about? Then you have the normal, standard normal probabilities are available. You are required to determine the maximum possible investment. 99%, I want you to observe here, 0.9901, 99% is at 2.33. If you remember the value at risk formula, you will have a multiplier of 2.33. Coming back to this. So what is the story here? He has got 7 lakhs balance in his bank account, and minimum balance he need to maintain is 1,000. So how much he can trade? 6,99,000 he can trade. Okay. 6,99,000 is the risk that he can take. Whatever money that he is investing on that positions, he can take options, forwards, futures, whatever position that he takes. Adala, if there is a downside risk, that downside risk and loss can be maximum 6,99,000. That is when then from his main bank account that money will be taken out. You know that margin concept. From that main bank account, money will be taken out. So the revised balance will be 1,000 rupees. That's what we are all talking about. So what is the value? So that is the value at risk is 6,99,000. That's what is available. You need to find out what is the investment. Let's go to the value at risk formula. Minimum balance is balance in the account is 7 lakhs. Minimum balance to be maintained is 1 lakh. Maximum loss that can be incurred is 6,99,000 in any one day or cumulatively in total of 4 days. The value at risk is invested amount into standard deviation into 2.33 into square root of t. So 6,99,000 value at risk is equivalent to the amount that you are investing. We don't know what amount you are investing into 1.5% standard deviation into 2.33. 2.33 is there as a part of the formula itself. If you want to take a note of this question, it says 99% confidence index. See that in the table. In the table, it is 2.3 on that 3. 2.33 into square root of 4-day position. If you are taking 4-day position, it is square root of 4, which is 2. So if you solve it, the value of x will be 1 crore. This is one way of understanding. It is straight. This question only tests you whether you have understood the concept of value at risk. Value at risk, I think we would have solved a very small problem on this. What is value at risk? We would have explained and then we would have solved a problem on this. Just refer this. You need to pick up the amount what would have solved is invested amount into standard deviation into 2.33 into square root of 3, square root of t. Here it is the flip side, the other side. Okay, investment amount should be found out. Value at risk is available. Now, there is other way of interpreting this. Someone can say that, see, I have 4 days time, Tuesday, Wednesday, Thursday, Friday. At any point of time, I'm not taking a 4-day position. I'm taking a day-on-day position. So at any point of time, the maximum risk that I can face is 6,99,000. Abdinna, how much amount I have to invest? So someone can say that alternative to 6,99,000 is equal to x into 1.5% into 2.33 into square root of 1 in any one day, because any time during the day my value should not go below that 1,000. So anytime, even for one day, the risk that I can take is only 6,99,000. If on one day the value goes down to a greater depth, then the maximum loss that I can see is only 6,99,000. That's another argument someone can take. In that case, x is equivalent to 6,99,000 divided by 1.5% into 2.33. In which case we get a value of 2 crore. Anyone is okay. You take a 4-day cumulative position or you take a day-on-day position, any answer is right. This question basically tests you what do you know about value at risk. Value at risk formula 3 ma 3 ada. If you know this formula, you will be able to answer this question, right? In my view, this question is a very straight question. There is no big twist in this. Just you need to think about this 1,000 and then arrive at the fact that 6,99,000 is the risk that you can take. That's it. Next is question 2A. AB Limited has equity capital of 12 lakhs and debt of 8 lakhs and annual sales of 30 lakhs. 2 mutually exclusive proposals are under consideration for the next year. The details of the proposals are as under. Proposal 1, Proposal 2, target assets to sales ratio, net profit margin, debt equity ratio, retention ratio, annual dividend, new equity raised, 1 lakh. You are required to calculate sustainable growth rate for both the proposals. So the question is clear. You are required to calculate sustainable growth rate. How do you, sustainable growth rate is a concept that we discussed as a part of mergers and acquisitions. Sustainable growth rate, there is a formula. If you remember, sustainable growth rate is net profit percentage into retention ratio into 1 plus debt by equity, the whole thing divided by asset turnover ratio minus numerator. That's the simple growth rate is equivalent to B into R. The simple growth rate. Sustainable growth rate, we had this formula. We need to just plug in the numbers and then find the answer. That's it. I want you to understand one thing. The equity capital and debt 12 lakhs and 8 lakhs that they are having now, that's one side of the story. And the sales that they are having now, 30 lakhs, is one side of the story. But that doesn't determine their growth rate in future. What determines their growth rate is only their proposed ratios, right? If you see proposal 1 lakh, target debt equity ratio is 2:3. What is the present debt equity ratio? Present debt equity ratio is also 2:3, correct? So the present debt equity and target debt equity are same in proposal 1. Proposal 2, it gets bounced off. The target debt equity is 4:1. Present debt equity is 2:3. So they have to realign their debt and equity position. That's an understanding. So if my total capital base is 12 plus 8, 20 lakhs, long-term funds, they have to split that long-term funds into 4:1 proportion. They have to buy back some of their equity by issuing debt. That should happen. Then only their capital will align in the format of 4:1, and then only other things will happen. So that's an internal understanding. Annual sales of 30 lakhs is at the moment, but in future we don't know. With this proposal, sales will go up, sales will fall down, we don't know. We only base it on the asset turnover ratio, right? With this in mind, let us start solving sustainable growth rate. Simple growth rate is B into R. Sustainable growth rate is net profit percentage into retention into 1 plus debt by equity divided by asset turnover minus numerator. Proposal 1, let's substitute the numbers. Net profit percentage, 4%. Then retention percentage, how much is retained out of it? 75%, right? 1 plus debt by equity. 1 plus debt by equity is 2/3, right? The whole thing divided by asset turnover ratio, target asset turnover ratio. Everything is targeted. 0.65 minus numerator. And if you do that, you get 8.33%. Are we clear on this?
Yes, sir.
Yes, sir. Yes, sir.
Now comes proposal 2. Proposal 2, a little bit of working is required. See, we need to wait for the institute to come out with suggested answers. We need to see what is the position that they are taking. Nevertheless, I am arriving at 2 alternative answers. One number looks very off the track. That doesn't seem to be a feasible alternative. Another number looks very similar to proposal 1. Numbers are looking very similar. So I think that is what most probably will be preferred. Let's check. Let's fill up the numbers. So net profit percentage, again starting with 5%, NP percentage into what? Into retention percentage. Is the retention percentage and target retention ratio is not given here, right? The second proposal. But what they have given is annual dividend is given. Annual dividend is 0.3 lakhs. So since that is given, if we find out the total profit and if we use this 0.3 lakhs as dividend distributed, we know how much is the retention percentage. So this is the clue available for us to find out the retention percentage. Just have it in your mind. Retention percentage into 1 plus debt by equity. Debt by equity is 4:1. 1 plus 4/1. The whole thing divided by asset turnover ratio is 0.62. 0.62 minus the numerator. So to crack this problem, all that we require is the retention ratio, right? How much we are going to retain. What is given in this problem? The dividend is given, 0.3 is given. We need to find out the profits, right? If I find out the profit, I'm done. How do I find out the profit? Net profit margin is available. So I need to find out the sales. And if I find out the sales and multiply it with 5%, I get the profit. And from that profit, I use this dividend. I know what is the retention percentage, right? So all that I need to find out is the sales. How do I find out the sales? Asset turnover ratio is available, 0.62. That's the only clue which is available, 0.62. New equity raised in 1 lakh. So how do you look at this? New equity raised is 1 lakh. So probably debt 4 lakhs must also be should also be raised. It's an assumption that you can make. So 4 plus 1, 5 lakhs will be the total asset base of this company. Asset base in the revised under proposal 2, 5 lakhs will be the asset base of the company. 5 lakhs will be the capital base, long-term funds. So that should be the assets. If 5 lakhs is the asset, 0.62 times, then you can find out what is the sales turn. I mean sales, correct? From there you can take the lead. So this is assumption 1, alternative 1. New equity raised is 1 lakh. Debt proposed should be 4 lakhs. So total asset base should be 5 lakhs. Asset turnover will be that divided by 0.62. So you have 8 lakhs something. Net profit will be 5% on that. Dividend is 30.3 lakhs already given. So it's 25.6% is the retention. I'm sorry, this is 1 minus 75% is distributed, 25% is retained, 1 minus, correct? So this 25.6%, if you substitute it here, you will get the answer. 11.51 is an answer. Are we clear about this approach?
Yes, sir.
But the
Yes, sir.
problem in this model is that the sustainable growth rate should always be calculated with reference to the overall equity base and the overall size of the company, not just this proposal. So I am assuming the next way is equity raised is 1 lakh. If equity raised is 1 lakh, revised debt equity will be how much? Your existing debt and equity, remember it is 12 lakhs plus 8 lakhs, correct? So, I mean, the first line of the problem, if you remember this, 12 lakhs plus 8 lakhs is your existing debt equity. Revised equity, 1 lakh is added. So totally what will be the revised position of this company? 21 lakhs will be the revised debt and equity, which should be equivalent to your asset size. Is this 21 lakhs in 4:1 ratio? It is not in 4:1 ratio. Equity is 12 plus 1, 13. Debt is 8. It's not in 4:1 ratio. We assume that they are going to buy back some equity. They are going to issue some debt internally to match their targeted 4:1 ratio. So in order to achieve the sustainable growth rate. That of the problem. If 21 lakhs is the asset base, then again recalculate 0.62, 33 lakhs 87,000. Net profit should be 5% on this. Dividend is 30,000, which is declared. So retention should be 1 minus that, which is 82%. If you substitute 82%, your sustainable growth rate comes to 49.4%. In either case, whether you follow the first alternative or the second alternative, whether the proposal level you are calculating SGR or the company level company level you are including and calculating SGR, you find that the first proposal is weak, right? So you can say second proposal is preferred. Proposal 2 is preferred. Alternative 2 looks way off the regulars, hence may not be considered. That is my recommendation. But if you read this problem, I just want to pick your brains. Look at the net profit margin. Which proposal is better?
I think second proposal, sir.
Correct?
Second proposal.
Second proposal is better. Look at asset turnover ratio. Assets by sales. For making a 1 rupee sale, you require 0.65 assets. For making a 1 rupee sale, you require only 0.62 asset, which is preferable.
Proposal 2, sir.
Proposal 2
only, sir.
To execute proposal 1, you require a debt equity of 2:3. To execute proposal 2, you require a debt of 4, only equity of 1. From an equity shareholder perspective, which is preferred?
Proposal 2.
Proposal 2, right? You don't need to pay much of your money. You can borrow from bank and finish off that project. You see, proposal 2 is always lucrative in all the three perspectives. So eventually, the growth rate for the equity shareholder should be whooping up. That's the reason why I have put in a second alternative saying that a 49% some number. Because instead of 2:3 debt equity, 3 times equity, you're doing only 1 time equity. You see what's happening? You're investing so less in that company and you're able to squeeze more in terms of your net profit, asset turnover, everything. So definitely your growth rate for the equity shareholder should be much, much higher. So that's the understanding. Are we clear? Can we move on to the next question?
Yes, sir.
Yes, sir.
Next. Question B. So, okay, comments on this question. Proposal 1 is a straight case. You need to calculate SGR straight. Proposal 2, you have to take an assumption and complete that question. And the assumption, how logical we are at our assumption, is what will be tested. If you know the SGR, sustainable growth rate formula, you will be able to crack it. IB, an Indian firm, has its subsidiary in Japan, and Zaki, a Japanese firm, has a subsidiary in India, and they are facing the following interest rate. IB, Zaki. INR floating rate, BPLR plus 0.5, BPLR plus 2.5, Japanese yen fixed rate 2%, 2.25%. Sorry. Zaki wishes to borrow rupee loan, okay, at a floating rate. So Zaki wishes to borrow a rupee loan at a floating rate. So their applicable rate is BPLR plus 2.5%, right? IB wishes to borrow Japanese yen at fixed rate. IB wishes to borrow Japanese yen at fixed rate. So their applicable rate is 2%, correct? The amount of loan required by both the firm is same at the current exchange rate. Financial institution may arrange a swap between them and they require 25 basis points for its commission. Gain should be shared equally. I'll stop the question here. Can we quickly recall? If they do a swap, what will happen? IB will take a floating loan and then give it to Zaki, correct? Zaki wants a floating rate loan. So IB will take a floater and then they will give it to Zaki. So what will be the benefit, interest rate benefit that comes out of this floating rate loan? Anyone can answer?
1.5%.
How do you get that?
2.5%. Sorry, 1%, sir. Sorry, 2%.
2%, correct?
2%, yeah.
BPLR plus
2%.
2.5, BPLR plus half. So it's like 2%
Yes.
is the benefit that you get. And IB wants this loan fixed. Zaki will take a fixed loan and give it to IB. Zaki will take it for 2.25 and give it to IB, where IB's borrowing rate itself is 2. So you understand that there is a loss on this fixed rate, correct? Because of that swap. Because of the swap, I have to borrow floating and you have to borrow fixed. So you have a disadvantage over me on this fixed rate loan, 0.25. So you can say this 2% is your gross, gain on this floating, and loss on this fixed is 0.25, correct? So 2% minus 0.25, what is the net gain that we have? 1.75%. 1.75%, what is the intermediary charges? 0.25%. 25 basis points, 0.25. So 1.75 minus 0.25 is 1.5%. 1.5% will be shared equally between these two parties, which is 0.75 and 0.75. Are we clear on this?
Yes, sir.
Whether a swap can be arranged which may be beneficial to both the firms, what rate of interest will the firm end up paying? Humpty number of problems we have solved in swap, same question. Nothing, I don't think this question is tricky. It's a very standard question on swap. Just we need to find out what is the, if you follow the swap chapter, if you have solved any 3-4 problems in any book, you should be able to answer this question. Gain on floating, loss on fixed, gross gain 1.75, intermediary charges 0.25, net gain 1.5. Each one of them will get half. 0.75, 0.75. So what IB will do? They'll take a floating at BPLR plus 0.5, and then they pay the counterparty 2%. They receive from counterparty BPLR plus 1.25. Intermediary charges they don't bear. Net cost is 1.25. Zaki is concerned they take a 2.25% loan. They pay to bank. They get back 2% out of this, and then they pay to counterparty BPLR plus 1.25. Intermediary charges 0.25. Net cost will be BPLR plus 1.75. It's a very standard question in swap. So again, in my view, this question is a very simple question. I don't feel any difficulty, no twists and turns in this question. Are we clear? Can I move on to the next question?
Yes, sir. You can go ahead. Yes, sir.
Invariably, just to ask you, between these two companies, which company is a stronger company, which company is a weaker company? Between IB and Zaki, which company do you think is a stronger company, which company is a weaker company? Which has got higher credit rating, which has got lower credit rating? Yeah.
IB, sir.
IB is a
Stronger company.
stronger company, right? you know that flow of discussion, right? Stronger company, what they do, weaker company, what they do. Just recap what we have been discussing. Their interest rates are apparently low compared to Zaki, correct? Interest rate offered by the bank to IB is BPLR plus half, whereas even BPLR plus 2.5. For IB it is 2%, where here it is 2.25%. So obviously this is a stronger company. They demand a higher credit rating and they demand a lower interest rates compared to Zaki. It's an off the question understanding. Next is theory. Theory I am not discussing. I'll give you the reference in the study material. 3A. Okay. This how many marks is this? This is 8 marks. The 8 marks straight away you can take this up. The following data are available for a bond. Face value 10,000 to be redeemed at par on maturity. Coupon rate 8.5% per annum. Years to maturity is 5 years. YTM is 10%, right? So can someone confirm me what is the coupon rate here and what is the yield here? Coupon rate is
8.5%.
8.5% and yield here is
10%.
10%. So yield na, what does it mean? Yield till maturity na, what is the expectation of the investor? What is the discount rate? What other bonds are giving, correct? That's 10%. And my bond is giving 8.5%. What do you think? This bond will be traded at par, premium or discount? Discount. Obviously, correct? It's compounded at 8.5% and discounted at 10%. So it has to be traded at a discount. Just have that in background. It's redeemed at par. So there is no extra money involved anywhere else. You are required to calculate what? Current market price, you can calculate Macular's duration, volatility, convexity, expected market price if there is a decrease in YTM by 200 basis points. If there is a decrease in YTM by 200 basis points by Macular's duration by intrinsic value method, given a table. So let's work on this. I think these are all straight things here. I don't think we need to struggle too much to calculate this. These are all straight templates. Clear? This is 8.5%, 5 years. 5th year you get a 10,000. Yield is 10%, discounted at 10%. You get discounted cash flow. What you get is the current market price of the bond. Are we clear up to this?
Yes, sir.
Yes.
Discounted cash flow into time, Potona, you get this. And this duration is sum of products by sum of discounted cash flow. Correct?
Yes, sir.
You get 4.25 years. And how do you calculate volatility? Volatility is duration by 1 plus yield till maturity. Correct? 4.25 divided by 1.1. Correct? 1 plus yield till maturity. And how do you calculate convexity? Convexity, you will have to have one more column. Discounted cash flow into T plus 1. This into T plus 1. Sum of this. And then you have the formula. This sum of products by sum of discounted cash flow, the whole thing divided by 1 plus I the whole square. 2,27,145 divided by 9,431, the whole thing divided by 1.1 square. Right? The last straight application of formula. There is no interpretation at all. Next, if the yield decreases by 200 basis points, what do you say? Volatility 3.87%. Can someone comment on this? When you say volatility is 3.87%, what is your understanding? If the interest rate, what? If the interest rate goes up by 1%, correct?
Yes, sir.
The current market price will fall down by
3.87.
In fact, this is 3.87 times. 3.87 times of that 1%, correct?
Yes, sir.
So 3.87% it will fall down. If the interest rate yield decreases by 200 basis points, 2% if it falls down,
It will
if
increase.
interest rate decreases, current market price will increase, correct?
It will increase.
It will increase by 3.87 into 2 times, which is 7.728%. So what is the current market price? 9,431 plus, actually it's plus. Add 7.728%, you get some 10,160 something. So this is the revised market price. This is as per duration method. Expected market price under duration method, expected market price under intrinsic value method. What is intrinsic value method? Regular discounted cash flow. Same 850, 10,000. Now the revised yield is 8%. Are you following me?
Yes, sir.
Earlier it was what? 10%.
10%.
Now we get 8%. So you get 10,199 is the current market price. This will not be same as that of 10,160. It has to be same theoretically speaking, but it will be different because of convexity. If you adjust for convexity, you'll get all the more close number. Correct? There are Humpty number of problems which we solved on this. These are all straight questions. Can I move on to the next problem?
Yes, sir.
In the question, I don't rate any difficulty, ma. This 7 marks, I don't feel any difficulty. Just that you will have to solve it. 1-2 questions, there will be some, some twists and turns will be there. That doesn't make the entire paper subject matter of trolls and memes. Then this is on mutual fund. Mutual fund, normally the kind of question that they are asking is, they want you to find a balancing figure. That has been the way. Let us look at this question. Messrs. Corpus and AMC on 1/4/15 has floated 2 schemes: dividend plan, bonus plan. In this question, I'll tell you there are some serious errors in this question. I'll tell you what. Dividend plan and bonus plan. Mr. X, an investor, has invested in both the schemes. The following details are available. Now, what is the details available? Both the schemes, dividend plan, bonus plan. 1/4/2015, he invested. We don't know the information. 16 la 1:4, 1 unit for 4 units held. That is the bonus which is given. So dividend plan NAV is 47. Here it is 40. So the net asset value at various dates are given. 16, 17, 18, 19, 20 net asset value is given. And bonus is declared once here and once here. And dividend is paid 12%, 10%, 15% at different points of time, right? Sorry. What is the other information available? Investment, first plan is 9,20,000 dividend plan, and 10 lakhs is the bonus plan. Apparently, it looks like 2 columns. And average profit made in dividend plan is 27,748, and average yield is 6.4% here in bonus plan. Sorry, you are required to calculate what? Issue price of both the schemes as on 1/4/15. Issue price. 1/4/15, what is the issue price? What is the NAV at that point of time? That is what we need to calculate. Let us ask this question first. You have 2 plans to invest. One is a dividend plan, another one is a bonus plan. Is it a dividend payout or is it a dividend reinvestment? Guys, is it a dividend payout or dividend reinvestment? That information is not available, which is actually a problem. We have to take an assumption. We have to take an assumption that it's a dividend. Any assumption is okay. I am assuming that it's a dividend payout, right? If it is reinvested, what will happen? The number of units will increase, no? Terminal number of units will be more than what you have invested for. That creates another confusion. So let's go step by step. Dividend plan. To start with, what is the investment made? 9,20,000 is the investment made, correct? I made an investment on 1/4/2015. At that point of time, what is the net asset value? I don't know. Whatever be the net asset value, divided by that net asset value, you get that money, right? You get the number of units. I have to assume that something should be the face value. What will be the face value of that unit? Normally, face value of any unit of mutual fund is 10 rupees. 10 rupee will be the face value, and then your traded price will be something else. Your traded price is the net asset value. Assume that 10 rupees is the face value. Some assumption you will have to take to solve the problem because lot of variabilities are there. Here they have asked you only for NAV. So I am assuming that face value is 10. If face value is 10, what is the immediate next conclusion? All your dividend will be declared only as a percentage of face value. So here it is 1.2 rupees. Here it is 1 rupee. Here it is 1.5 rupees. Totally 3.7 rupees I have received on account of this 10 rupee face value one instrument. Okay. So total dividend received is 12%, 10%, 15%. So 37%. on the face value of the instrument. It is assumed that dividends are paid out, not reinvested. Question is not clear, so I'm assuming it that way. Assume that the face value of mutual fund is 10. Total dividend received will be 3.7. Correct? What is the redemption price that you have? 31,320 when you redeem it for 49. Correct? So how much cash you get upon redemption? 49. How much dividend you got in the last 5 years? 3.7. So what is the total cash flow that came out of this mutual fund investment? 52.7. This is the total cash that you have generated. Keep this on one side. On the other side, the question also says, on an average, how much profit you have made? 27,748.60. This is the yearly profit, correct? Average profit. How many years you have invested? 1, 4, 15 to 20, 15, 16, 16, 17, 17, 18, 18, 19, 19, 20. 5 years you have invested. So what is the total profit that you have made across 5 years? 27,748, 5 times, right? Now, what is your investment made? 9,20,000. That is the first line of the problem, investment made. So your total profit 138, what is your total cumulative cash flow that you generated out of this investment is 10,58,000. So per unit it is 52.7. Totally you have generated 10,58,000. So how many units you would have got is 10,58 divided by 52.7. So this is the number of units that you have got. So how much you have invested again? 9,20,000. 20,000 units you have invested. So the investment price is 45.97. I have explained it top down, but I want you to understand it bottom up. You need to find out what? You need to find out what is the net asset value here, correct? If you want to find out net asset value here, how do you get that number? You get that number by finding the total amount invested divided by the number of units. So you have total amount invested 9,20,000 divided by number of units X. If you find X, the problem is solved. How do you find out the number of units? Number of units you don't know at the investment stage, but you know at the redemption stage. Redemption stage, number of units multiplied by the total profit is equivalent to your total cash flows. So total cash flows divided by total profit should be equivalent to number of units. Now go bottom up. You should be able to solve this problem. So investment price is 45.79. Case 2, bonus on it's pretty simple. Bonus what they have given? They have issued bonus twice. 1:4, 1:5. I don't know how many units I have invested. Assume that I have invested X units, right? On 31/12/16, I get 1/4 of it. 0.25 gets added. Whatever be that number, bonus, it gets added. Adil again 1/5 will be there. So coming back here, on acquisition, you invested in Y units. Once you get 1:4 bonus, so it becomes 1.25Y. Once again, it becomes a 1:5 bonus. Idila 1.25 la 1/5 bonus will be given. So your total number of units will be 1.5Y at the end of the tenure, correct? Now, at the end of the tenure, what is the closing value? 44. 44 is the net asset value. So 44 net asset value into your total units should be equivalent to 66Y. That is the equation. What is the profit that you made for 5 years? It's already given here. 6.4% is the yield. So 10 lakhs you invested, 6.4%, 5 years, total yield is 3,20,000. So your closing value will be, terminal value will be 10 lakhs plus 3,20,000, which is 1320. This 1320 should be equivalent to 66Y. So Y should be 20,000 exactly. If it is 20,000, the amount that you invested is 10 lakhs. 10 lakhs divided by 20,000, the value of the investment should be 50. The fundamental is the same. You need to find out net asset value on day one. How do you find out net asset value? Total investment divided by total number of units at that time should be equivalent to net asset value. So we need to find out the number of units here. And how do you find out the number of units? If information is not available at the investment date, go to the redemption date. Redemption date, the formula is the same. Total cash flows that you got divided by total number of units should be equivalent to benefit per unit. That's it. Based on this, you solve it and then get the number. Again, I'm saying this requires a little bit of thinking in the exam hall. This doesn't strike just like that. You will have to think in the exam hall. I would rate this question as a moderate difficulty problem. You don't find anything new here. There is no new concept that you find here. Everything is already there. You know all these things. Just that you need to think in the exam hall to solve this. Are we clear? Can I proceed to the next problem?
Yes, sir.
Yes, sir.
Question C is theory. Question 4. This is a question on M&A. ICL is proposing to take over SVL. ICL is proposing to take over SVL. ICL is the buying company with an objective to diversify. ICL's PAT has grown 18%. SVL's PAT has grown 15%. Both the companies pay dividend regularly. Sorry. Summarized P&L of both the companies are given. ICL, SVL. Summarized P&L, net sales, PBIT, interest, provision for tax, PAT, dividend, undistributed profits, everything is available. So their fixed assets, land and building, plant and machinery, balance sheet is also available. Current asset, current liability, creditors, OD, provision for tax, provision for dividend. This is net assets subtotal. Current asset minus current liability, net assets total. Paid up capital is given, reserves, borrowing, capital employed. Okay. Market price per share is also given. So what is required? ICL's land and building. ICL's land and building are stated at current prices. That's the buying company. SVL's land and building are revalued 3 years ago. There has been an increase of 30% every year in the value of land and building. So the land and building value has gone up 30% every year. SVL is expected to grow 18% year per annum after merger. If you remember the first line of the problem, ICL growth rate is 18%. SVL growth rate is 15%. And now it says SVL is expected to grow 18% per annum in future. So your selling company target that will grow at the rate of 18% per annum in future. ICL's management wants to determine the premium on shares over the current market price, which can be paid on acquisition. ICL's management wants to determine the premium on shares over the current. What is the current market price of SVL? 75. You do a revised calculation and then find out what is the revised market price. Should we need to pay a premium or not? That's what we need to know. You are required to determine the premium using first method, second method, and then third question. First method, net worth adjusted for the current value of land and building plus the estimated average profit for the next 5 years. Second, dividend growth formula. Third, ICL will push forward which method during the course of negotiation. Let's go one by one. We need to value the other company. Substance of the question is this. We need to value SVL. How do you value it? Net worth. Net worth is assets minus liabilities, correct? Adjusted for the current value of land and building. What is the adjustment on current value of land and building? SVL. Which asset is not revalued, or which asset takes an adjustment here in SVL?
Land and building.
Land and building. It is revalued 3 years back. Now, how much percentage it has to be revalued?
90% it should revalue.
Yeah, 30% 3 times,
90%.
right?
3 times.
Plus estimated PAT for the next 5 years. So the value of the company is net worth plus PAT for 5 years. This is the model that they have given. There is no logic behind it. 5 years profit needs to be added. Say that you are going to pay money. Second, on the dividend growth formula. Dividend growth formula. Now, what is dividend growth formula? What is growth model? Dividend growth formula. Market price per share is equivalent to, any guess? Gordon's growth model. D1 by K minus G. Correct?
Yes, sir.
Yeah. How do you get D1? D1 is nothing but D0 into D0 plus the growth that you will consider, right? By KE minus G. 3 numbers, if you find out, you can find out the value of this share, right? And then ICL will, if you know these 2 answers, then you can answer the third one. ICL will push forward which method during negotiation, right? So let's go step by step. Model 1. Model 1, they are valuing land and building. What is the land and building book value here? The book value of land and building is 190, correct? Now this 190 is revalued 3 years back. Now you have to revalue 30% upward revaluation needs to be done. There is a future value interest factor is given 30%. So consider it, take the land and building value, right? And then plant and machinery, furniture, all these things, you can retain the same number. Plant and machinery, furniture, current assets, creditors, provision for tax, everything, all the other numbers you can retain as it is. And then you get the net assets here. Net assets is 1012. And then estimated profit for the next 5 years. You know what is the existing profit? Existing profit is available. PAT on the 250, it is available. And in future, the growth rate is how much? What is the future growth rate of SVL?
It's 18% after
18%. Either past
merger.
percentage is 15, you take 18% in future, and then 18% you add on, and then find out what is the estimated profit for the next 5 years. Total yield is available. And when that is available, value per share is that this is the total value of the company. Value per share is this total value divided by number of shares. Number of shares in 125 divided by 10, 12.5. You get the value per share. What is the current market price? 75. How much premium you are going to pay? 174.83. Coming down, second method, D1 by KE minus G. You need to find D1 KE G. Growth rate already you know, 18% given. How do you find out KE? KE is not available in this problem, but you know what is EPS by MPS. MPS by EPS is PE ratio. 1 by PE ratio is KE. So inverse of this. So you can find out EPS. EPS here is earnings per share, PAT 250 divided by 12.5. Correct? So that will give you the EPS. And you know what is the MPS here? MPS is already 75. With these two information, you can find out what is the KE. Then the last thing is D naught. What is the D naught available? D naught available is 125 divided by 12.5. The dividend declared here, 125, right? So substituting all these things, and D1 is going to be this into 1.18. Okay. With these things, you can calculate the value per share, D1 by KE minus G. Current market price is 75, so the premium payable is 61. If you look at model 1 and model 2, the buying company would prefer model 2 since it results in lower premium more than the current market price. That's the conclusion, right? So that is on question 4A. It's a very standard question on merger. $4B. USD $10,000 is lying idle in your bank account. You are able to get the following quotes from the dealer. Euro by USD 1.1539, Euro by GBP 0.9094, GBP by USD 1.2752. Is there an opportunity of gain from these quotes? I mean, I still remember a similar question solving in these lines. If you look at this, there is a Euro by USD, which is a direct quote available, right? And if you look at these two things, Euro by GBP, GBP by USD, there is an indirect quote that is available. Euro by GBP into GBP by USD. You get Euro by USD, correct? So there is a direct quote and there is an indirect quote. You need to check whether the rates are same or different, if there an arbitrage exists or not. Are we clear on this?
Yes, sir.
But there is one point which I also want you to be careful. If I look at this, GBP by USD, GBP by USD 1.2752, what does it mean? How many what currency for what currency? 1.2752
GBP per US dollar.
It doesn't work. No, GBP is a stronger currency, correct?
Yes, sir.
So
Yes, sir.
this is an inverted quote, correct?
Yes, sir.
This has to be read. Remember, we have a similar problem solved on these lines. This has to be read as USD by GBP, correct?
Yes, sir.
Everything must be understood in an inverse way. It should be USD by Euro. It should be GBP by Euro. It should be USD by GBP, right? So that's the only thing that we must be aware about. $10,000 lying. Okay. Going back to the problem. So given quotes are inverted quotes, Euro by USD should be read as USD by Euro. Just be careful. USD by Euro, first one. First one is Euro by USD. USD by Euro. 1.1539 USD per Euro. This is direct quote. Indirect quote is cross currency. If you multiply these two things, what you get is a cross currency quote. 1.1597. So direct quote 1.1539 buy sell. Indirect quote 1.1597 buy sell. So you will buy here 1539 where it is cheap, and then you will sell here where it is costly. Correct? And then demonstration here. Buy €1 for 1.1539 with $10,000. You buy 10,000 divided by this much. And with that, your sell price is 1.1597. You sell the entire €8,666 and then you get $10,050. So the arbitrage gain that you make is $50. It's a straight question, right? Can I move on to the next question? Third one on the theory. Okay. Look at this question. ICL, an Indian MNC, is executing a plant in Sri Lanka. Just give me a minute. ICL, an Indian MNC, is executing a plant in Sri Lanka. It has raised 400 billion rupees. Okay. Half of the amount will be required after 6 months' time. Half the amount, not 200 billion, is required after 6 months' time. ICL is looking an opportunity to invest this amount on 1st April 2020 for a period of 6 months. What does it mean? How much money they are investing? Guys, how much money they have raised? They have raised 400 billion, correct?
Yes, sir.
Yes, sir.
Half the amount will be required after 6 months. Abdina, what does it mean? Other half is required today itself. So that's an assumption. ICL is looking an opportunity to invest this amount in what 200 billion rupees on 1st April 2020 for a period of 6 months. This amount in what 400 billion this amount, half the amount to this amount. I don't know.
Of the amount which they no one need.
Fine, perfect. I believe that. That's the idea. It is considering two underlying proposals. I have one more reason why I say it's half the amount. I'll tell you. Once you see the answer, you will understand. They can invest it either in Japan or in US. Syria, the 200 billion rupees. In Japan, they can invest in index fund. In US, they can invest in treasury bill. Dividend that this fund will give is 25 billion. Income from stock lending scheme is 11.9276. Discount on initial investment at 2%. Interest nil. US bond, it gives you 5% interest per annum. Exchange rate today is given 1.58 Japanese yen JPY by INR, and it is 0.014 USD per INR. Exchange rate here it is 1.57, and then here it is 0.013. Okay. You as an investment manager is required to suggest the best course of option. Which one would you prefer? That's the question, right? If you take the US Treasury route, let me make it very clear. If you take this US Treasury route, what will happen? You will be investing this in dollars, convert this into dollar today, invest it, you get 5% interest. This is a per annum interest. So 6 months interest you will be getting. And towards the end of 30th September, you will redeem it and you will get cash, correct? So this is one option. If you are investing here, what will happen? You will be investing in Japanese yen, convert this into Japanese yen, and that you will be investing. What are all the dividend you get fixed? 25 billion. And what is the income from stock lending scheme? You will get an income from stock lending scheme also, 11.9276. And then your initial investment will carry a discount of 2%. 2% you will have to lose on your initial investment. So you get a terminal value in Japanese yen. The terminal value in Japanese yen has to be reconverted using the closing rate, correct? You get what is the cash available on 30th September. So find out whichever is beneficial, you will have to do it, right? I'm not sure, but I remember a similar problem. I'll tell you what. One company in international finance, there is one problem. You check your notes. One company which has got surplus in one region and deficit in two regions. Either they consolidate all these things in one region, invest, or they borrow in respective countries and invest in respective country, and then they terminally converge it. There is a question. Please check. This is very similar to that. So amount available. So index funded treasury bills. That's it. I'm just giving you the answer here, but the snapshot is what already I discussed. So convert this into dollar, get the dollar amount, start charging interest, and then find the maturity value, use conversion rate, find out the terminal value. Similarly, index fund, convert it into Japanese yen, and then you add income out of it. Dividend 25, stock lending scheme also there, income is there, and then maturity value the initial investment 2% will get reduced because you lose on account of discount. You get a maturity value, conversion rate, you find out what is the net value. Okay. And then if I do this, apparently there is an indifference. So you say still invest in treasury bond because treasury bond is always preferable between index funds and treasury bonds. If there is an indifference, what will you conclude? If there is an indifference, you will say that treasury bonds are preferred than index funds. That's it. If 400 billion is invested instead of 200 billion, which is the first part of the question, if 400 billion is invested, you tend to conclude that US bonds are better because Japanese index funds the income is fixed 25 11.92 whereas it is a percentage basis, so you get more income if you invest more, but here it is frozen. So if it is 400 billion is the assumption, then you will find treasury bills are more preferred. Okay, this is a standard question where you will have to convert your investment into foreign currency, accumulate it, and then again take it back to local currency. Are we clear? Can I move on to the next question?
Yes, sir.
Yes, sir.
The following are details of 3 mutual funds MFL. Again, in my rating, this question is an easy question. It's a straight question. Convert, reconvert. That's what you need to do. Nothing much. Sideline information. Mutual fund, you get dividend in billions, right? Just to quickly understand, this 25 billion in what currency is that? What do you think? Japanese yen or INR? What is the casual assumption that you can take?
Japanese yen.
Obviously, Japanese yen. Income from stock lending scheme, now what does it mean? You invest in index fund, the investments that you have, you can lend it to someone who can do short sales. So he can borrow it from you, sell it first, and then buy it later, and then give you back that instrument for which you will be charging him. Now that's called a stock lending investment or stock lending income. That's what is income from stock lending, right? Just to give you a clarity on what this nature of income is all about. Next, the following are the details of 3 mutual funds MFL: growth, balanced, regular fund. And then you have market information. Average return is available, variance is available, coefficient of determination is available. Variance in a standard deviation is square root of variance, correct? Up to this we know. Coefficient of determination is also there. Yield on 182 days treasury bill is 9% per annum. Okay, this is RF. You are required to calculate, you are required to rank the funds as per Sharpe measure, as per Trenois measure, compare the performance with the market. So to solve this problem, you should know what is Sharpe ratio, Trenois ratio, correct?
Yes, sir.
So we have it here. Sharpe ratio is return on the portfolio minus RF divided by standard deviation of the portfolio. Trenois ratio, return on the portfolio minus RF divided by beta of the portfolio, right? So you have return on the portfolio, which is available. I'm just copying and pasting the question here. You have the variance, which is available. Variance square root of that is standard deviation. You have RF, which is available 9%. Substitute it, you get the Sharpe ratio. So this standard deviation is nothing but square root of variance, correct? So return minus RF divided by standard deviation. You get this. And how do you find out Trenois ratio? RP minus RF divided by beta of the portfolio. Return on the portfolio is available, RF is available, and all that you need to find out is beta. Study material, if you follow, study material, coefficient of determination, using this, you have a beta formula which is available. Either you can use that formula or simply, what is mean by coefficient of determination? Coefficient of determination is nothing but R square. Correlation square. Correlation square is called as coefficient of determination. That's the only thing that you need to crack. So either if you follow the study material method, they use the coefficient of determination formula to get the beta, or I will simply say You have the standard deviation of the portfolio which is available, and then you have the correlation. Correlation is square root of this, correct? And then you have the beta. Beta is standard deviation of portfolio into correlation divided by standard deviation of the market. Beta of the market is 1, always 1, correct? Beta of market to itself is 1. So with these things available, you can calculate the Tranor ratio also. RA minus RF divided by beta. And then you can rank them. And in either case, you understand that market performance is better than all the 3 funds. That's the conclusion, right? So in the question, this question is fundamentally simple question, Sharpe and Tranor ratio, but only one thing that you should be aware is coefficient of determination. You have the similar question available in the study material. Study material question is there. Okay. Moving on, question 4, C is theory. And 6A, which is the last question. 6A, BC is the last segment. An investor is considering to purchase the equity shares of LX Limited, whose current market price is 112. The company is proposing a dividend of 4 for the next year. LX Limited is expected to grow at 20% per annum for the next 4 years. The growth will decline linearly to 16% per annum after first 4 years. Thereafter, it will stabilize at 16% per annum infinitely. The investor requires a 20% return per annum. You are required to calculate the intrinsic value, whether it is worth to purchase the share at this price. Guys, can you help me out? What is the current market price of the share?
112.
112. What is D1 expected?
4 rupees 4.
4. Company is proposing a dividend of 4 for the next year. D1 is 4. And that 4 will grow at what rate?
20%.
For how many years?
For next 4 years.
For next 4 years.
4 years.
And then it will decline to what?
16%.
So I have a doubt. 4 will grow at the rate of 20% for the next 4 years. Now, how do you assume? First year 4, second year that plus 20%, third year that plus 20%, fourth year that plus 20%. Is that your assumption? Or first year 4, and then onward second, third, fourth, fifth, plus 20, plus 20, plus 20, plus 20. First option, or you understand the difference?
Plus 20%, sir.
Plus 20%, sir.
The plus 20% is okay. Yeah? Till how many years?
Oh.
Till 1, 2, 3, 4, or 1, 2, 3, 4, 5. Yeah?
1, 2, 3, 4.
1, 2, 3, 4. In my view, even if you go up to 5, there is nothing wrong. LX Limited is expected to grow at first year proposed on the 4 years only, 4 rupees, right? This is expected to grow at 20% per annum for the next 4 years. In the upcoming 4 years is an understanding. If you take upcoming 4 years, then from today itself, it is 20% growth. Apo, I would not have this doubt if this is a current year information. Has already declared a dividend of 3.5. And then next 4 years, it is 20% kurta doubt. They said first year dividend is 4, and then next 4 years it's 20%. Someone can take the other view also. Just be aware. But reasonably, we know we have been solving questions, so you know this is going to be only up to 4 years. Here 1, 2, 3, 4, right? The growth will decline to 16% per annum after 4 years. Growth will decline linearly to 16%. Linearly, na, step by step, that 20% growth will go down to 16% growth. Correct? So now you are at 20%. Next year it will be 19, 18, 17, 16. Are we clear about this? Guys, are we clear about this interpretation?
Yes, sir.
That is what it means.
Yes, sir. Yes, sir.
The growth will decline to 16%. 20 will immediately jump to 16. The growth will decline linearly to 16. Step by step, it will fall down to 16. Correct?
Yes, sir.
But here the problem here, linearly, how does it say 1% linearly? It can be even 0.5% linearly. Correct? But they say 16% per annum after 4 years. After 4 years. So someone can assume that it is 20%, then 19.5%, then 19%, then 18.5%, then 18%. Slow over 8 years, he will bring it to 16%. That is also possible. Question is not worded properly. They have to say the growth will decline linearly to 16% per annum after the first 4 years at the rate of 1% every year. then you can immediately jump. 20 becomes 19, 18, 17, 16. But they have not given it. At the cost of brevity, this question is creating confusions here. Thereafter, it will stabilize at 16% infinitely. The investor requires 20%. This is the discount rate. So solution is this. First year 4, and then it will grow at the rate of 20, 20, 20. Is everything clear?
Yes.
And then it will grow at the rate of 19, then 18, then 17, correct? And then 16. Eighth year, what is the dividend that you will get? This into 1.16, correct?
Yes.
So you have gone down to 16. From here onwards, it will be always 16, which is the growth rate, correct? The rate at which 13.17 will grow is 16%.
16%.
So this is D1, 13.17 by KE minus G. KE is 20% available, growth rate is 16% available. So I have said 11.36 into 1.16 divided by KE minus G. Pota, you get the 8th year to infinite year discounted to the present value, 7. Discount everything at 20%, you get the present value, so 114.97. Your current market price given in the question is 112. So what is your decision? Buy. Are we clear on this? This is a very standard question. Growth, இதில் add பண்ணதுன்னா linearly add பண்ணிருக்கான். That you should be able to think in the exam hall. That's it. Nothing difficult I find in this question. Okay. (6B). The management of a multinational company, this is the last question. The management of a multinational company, TL Limited, is engaged in construction of infrastructure project. The question is a bouncer. For many students, it is a bouncer. Let us see. The proposal to construct a toll road in Nepal is under consideration of the management. Okay. They are constructing a toll road in Nepal. The following information is available. The initial investment will be in purchase of equipment costing $250 lakhs. Economic life is 10 years. So they are purchasing equipment for 250 lakhs. Life is 10 years. Depreciation will be on SLM basis. EBITDA to be collected from the toll road is 33 lakhs per annum for the next 20 years. That's the EBITDA that will be collected from the toll road. 33 lakhs per annum. To encourage investment, Nepalese government is offering a 15-year term loan of USD 150 lakhs at an interest rate of 6% per annum. So, can you quickly confirm me your understanding? What is the value of investment? The value of investment is how much?
250 lakhs.
Life of the asset is?
10 years.
10 years. 10 years.
EBITDA you will receive for how many years?
33 years. Sorry,
No,
20 years.
20 years. So the income
Yes, sir.
generation is for 20 years. Asset depreciation is for 10 years. Correct?
Yes, sir.
10th year kapram, there will not be any asset. You will fully depreciate it. Then there will be only full cash flow.
Depreciate.
To encourage investment, Nepalese government is offering a 15-year term loan. So there are 3 timelines involved. Total life of the project is 20 years. Asset depreciation is for 10 years. There is a loan facility which is available, which is given to you. That loan facility will be for 15 years. Right? That will not be for full amount. That will be only for 150 lakhs. Correct? At an interest rate of 6%. The interest is to be paid annually. The loan will be repaid at the end of 15 years in one tranche. In one tranche, the full loan will be repaid. Up to 15 years, you have to pay only the interest, correct? Which is 150 lakhs into 6%. That's interest payable every year for 15 years. And at the end of the 15th year, you have to repay this 150 lakhs. The required rate of return is 12%. So that is the discount rate. Post-tax cost of debt is 5.6% per annum. Post-tax cost of debt. Corporate tax rate is 30%. All cash flows will be in USD. Ignore inflation. You are required to calculate, you are required to advise the management on the visibility of proposal by using adjusted net present value method. Adjusted net present value method. You remember there is something called as bridge topics that we would have discussed. This adjusted net present value method, base case NPV and adjusted NPV, it is basically forming part of CA inter syllabus. and CA final, they have touched upon it. There is only one paragraph in the study material that talks about adjusted net present value. What chapter is this topic? This topic is not international finance, very sure. This chapter is a capital budgeting. Capital budgeting is not there in our syllabus, but still they are asking questions on this. Fine. You need to comment on the viability of the proposal. I want you to recap what is base case NPV and adjusted NPV. Base case NPV means you evaluate whether a project is positive NPV or negative NPV, assuming entirely funded by equity. That is base case NPV. And then what you do, you slowly start injecting debt. When you inject a debt, what is happening to your net present value? Now that is an adjusted NPV. And then you decide what is the appropriate amount of debt that you should be having. That's base case and adjusted NPV. So base case NPV is cash flows of the project discounted, assuming that entirely it's funded by equity. Now, when we talk about an EBITDA of 33 lakhs per annum, right? I assume that the project is fully funded by equity. Upon interest itself will not be there. 15 years interest, forget about that concept. Base case NPV. So you take the entire 33 lakhs and then discount it to the present value. But there is a tax benefit on the depreciation, correct? Depreciation will be for how many years?
10 years.
10 years. So calculate 10 years depreciations tax benefit, adoda present value, that you add with this 33 lakhs, right? Look at this. Either what is the first method you will follow? I'll put it this way. 1 year, 2 year, 3 year, you can go up to 33 years. Put it, what you can say? You can say EBITDA less depreciation, correct? And then you will have PBT less taxes, then PAT, add back depreciation, then you have CFAT. Either discounted to the present value is the net present value. That is the present value of inflow. This is what we do normally, correct? Assuming that this is fully funded by equity, interest will not be there, right? This is very laborious work. 33 columns you cannot put. So what I'm doing, I'm taking the EBITDA here. Anyway, depreciation you are reducing and you are adding it back. Depreciation kind of tax impact has to be factored in. So what I do, I take the EBITDA completely and discount it to the present value one side. Depreciation's tax impact, I find the present value on the other side and add both. You get the same CFAT present value. Are you following me, guys?
Yes, sir.
Yes, sir.
So,
Yes, sir.
So here, EBITDA, your EBITDA is 33. The 33 ke full tax kudruvom. 30% tax goes off. So 0.7 out of this is 23.1. Without a present value table is given below the question. So it's 172.53. Now, but we have not considered the depreciation tax savings on depreciation. So what is the depreciation per annum? 25 lakhs, 250 divided by 10. Other tax savings is 30%, which is 7.5. Adoda present value is 42.38. So this plus this present value of inflow is 214.91, outflow is 250, base case NPV is minus 35.10. The project is not viable upfront. What is the extra thing that you have now? A loan which is offered by the Nepalese government. The loan is offered for how much? For how much the loan is offered for? Here, 150 lakhs.
150.
And what is the rate
150
of interest
lakhs,
that they are offering?
6%.
6% for 15 years. If someone says that, guys, come and help our country, even though you have a net present value, which is a negative net present value, help our country, will give you loan at a lower rate of interest, would you still take up that project or not? It all depends on what is the benefit that you get out of that loan. There is a lower rate of interest, fine. The interest will get a tax benefit. That has to be factored in. What is the formula for adjusted NPV? Which is base case NPV plus tax savings on debt minus issue cost on debt. So we need to find out the tax savings on debt. Tax savings on debt is 150 lakhs into 6%. That is the interest on debt, 9 lakhs. Tax savings on that is other 30%, 2.7 lakhs. This benefit will be available only for 15 years. So present value of that is 23.11, 2.7 into present value factor. I mean, all the years 2.7 discounted, 23.11. So the adjusted net present value will be 35, which is your base case NPV minus 35 plus the tax savings on the interest that you have 23. Still your adjusted net present value is minus 11.99. Even this is not sufficient. What you should not consider here is I am borrowing 150 today. I am going to repay 150 at the end of 15th year. Will it have any time value impact? That should not be considered, because the moment you say your outflow is 250, base case NPV 215, the moment you are saying, you are considering both debt, equity, everything put together. So again, you need not calculate a time value factor for that 150, right? So adjusted NPV is minus 11.99. Still the project is not viable. That is the conclusion, right? So this question is a pretty decent question. You will have to, the difficulty, I'll tell you why this question is difficult. One, people will not expect this question. They think it's more CA inter question, but it has come up in CA final. People will not be ready in the exam hall. Second, you will have to think. You will have to little bit think and then answer. So this completes question 6B, and the last one is theory. Theory, I have marked down all the theories here, and then I have given the study material page number reference. So I'll share this Excel file to you guys. The same Excel file is uploaded in fundazone.in. Website it is there. So you can download this Excel file from the website also. Overall, my review is that question paper has got difficult questions. No two opinions in that. But at the same time, you can skip over it. You have choices. At least I think every one of you must be sure that at least 5 questions or 6 questions offhand, you should be able to feel that you are comfortable at the moment, right? I mean, you guys are writing your exams in May 21 or whatever, but at least 4 to 5 questions you are able to comfortably say that the questions are simple. Like first question itself, the forex rate straight, these are all straight solutions, correct? Without any much preparation. Totally, how many questions are there? How many questions you need to attend? You need to attend 5 questions, yeah. Question number 1 is compulsory, answer only 4 from the rest. So you need to attend 5 questions. In every question there is 1 theory. So remaining 2 you will have to attend. So 5 into 2, 10 questions you need to attend. 10 questions, 5 questions, upfront you are able to comfortably feel that it's kind of okay, nothing much in that. Remaining 5 questions is yes, you will have to think and write in the exam hall. Is there any new concept that come in the question paper which don't even know? There is nothing like that. Do you need to think in the exam hall? You need to think in the exam hall. Many people commit that mistake. They want some familiarity over that question. Familiarity irkadu. You will have to think in the exam hall. You should be able to crack. Are there possibility of assumptions? There are possibilities of multiple assumptions. With each assumption, your answer will be different. Nothing wrong in that. Are there errors in this question paper? There are no errors. I would say there are some lack of clarity. In 2 questions, there are lack of clarity that like the linearly 16% per annum linearly, yeah, that's not properly explained. Probably that would have saved the life of students in the exam hall. So there are lack of clarity in the questions. But for that, this question to me is this question paper to me is a pretty normal question paper with moderate level of difficulty. What is your upfront review? Bharat, you have any points? You have any observations?
ஒரு 4 questions கிட்ட இருக்கும், you can solve it, sir, actually. If you have a good grip over the formulas as well as the concept, now கொஞ்சம் solve பண்ண முடியும், sir. You can score. But to aim for exemption, அந்த தியரிலையும் அந்த லாஸ்ட் நீங்க சொன்னீங்களே சார், அந்த பவுன்சர், அது எனக்கு ஆக்சுவலா ஃபர்ஸ்ட் டைம் ஐ எம் ஃபேசிங், பிகாஸ் நான் பிரிட்ஜ் டாபிக்ஸ் வந்து ஐவ் சீன், ஆனா எக்ஸ்பெக்ட் பண்ணல. நான் எக்ஸ்பெக்ட் பண்ணிருக்க மாட்டேன், இந்த மாதிரி ஒரு கொஸ்டின் வந்து பண்ணிருக்க மாட்டேன். பேஸ் கேஸ் என்பிவி அண்ட் அட்ஜஸ்டட் என்பிவி. ஆனா we have seen this similar concept in bridge topics.
Yeah. No, see, understand, we have solved the entire question paper. Exam hall, you have a choice. You can leave that sixth question in choice. You can focus only on 5 questions and work on it. That should be possible.
Yes, yes.
Nila, any points from your side?
I think we can attend, sir. எனக்கு நீங்க நான் எடுக்கும் போதே 5 to 6 questions கிட்ட ஸ்ட்ரைட்டாவே ஆன்சர் பண்ற மாதிரி இருந்தது.
Fair enough. And Kanak Selvan, you have any points?
No, sir. It's like all the topics we have covered and then discussed in the class itself. Like I definitely feel once I start it, this will be easy paper for me.
More thing, I conveniently escaped the theory. Theory that takes care of 20 marks, remember. I said theory, I'm not discussing theory, I'm not discussing. The theory is important. Theory will save your life. In fact, I'll put it this way. Anyway, you have to answer 5 questions out of that 6 questions. So theory, please guys focus. Everything I know, I have given the page number reference in study material also. So all that you need to do is sit with the study material, crack the theory. Because it carries 20 marks. So with a strong grip on theory and with a very fundamental understanding on class book and all the other things, students should be able to clear SFM. SFM should not be a problem at all. Theory grip irundana, you can aim for exemption as well. That's what I think. So yeah. So I think I would any more questions should I need to take, or are we done?
Yes, sir.
Yes,
Thank
sir.
you.
I'm comfortable. I'm comfortable, sir.
Thank you. All the best. All the best. Bye.
Thank you.
Thank you,
Bye,
sir.
sir. Thank you. Thank you, sir.
Bye.